All right. Welcome everyone. Thanks so much for joining us today. I guess we can get started. So, real quick, I'm Gigi Alsadi, the Crane Fellow here at Prime Coalition, and also I'm the moderator for today's panel discussion. And today's session is going to be all about how investors use forward-looking GHG impact data to make better decisions. But um, before we dive into our discussion, I'd like to just kick off with a handful of slides about Crane and its methodology and some updates, especially for those who are newer to our tool. Then we'll dive into our panel discussion with the three impact investors, followed by a short Q&A session. So if you have any questions, feel free to drop them in the chat as we go, or also you'll be able to unmute yourselves at the end and ask your question. So just a quick look at where Crane and other of Prime's programs fit into our broader work that we do at Prime. So Prime Coalition is a US-based nonprofit, and our mission is to turn bold giving into climate action. And we do this work using three key strategies. So first, shown on the left here is we deploy catalytic capital directly into early-stage climate solutions. And we do that through our two venture capital programs that includes Prime Impact Fund and Azola Ventures, each focusing on seed stage catalytic and impact first investments, as well as Trellis Climate, our most recent program with focus on financing first of a kind infrastructure projects. Then for our second strategy that's shown on the right, we have a strategy focused on building the field through knowledge sharing and just making it easier to incorporate climate impact into decision making. And that includes open access resources like Project Frame and its community of practice, and of course, the Crane tool, which we'll discuss more on that later. Lastly, I'd like to share some exciting news that we recently launched our nonprofit Climate Impact Advisor Services to just help folks do all of this work. So over time, what we realized is that even with the right tools and resources, capacity can often be a barrier. So we'd like to act as a third party to offer that extra hand for investors, accelerators to do forward-looking impact assessments, both using the Crane tool and without using it. And also we help them do impact case studies. So really, there's just more ways to make this work easier to access for everyone. And just as a quick reminder, Crane is a free open access tool currently available for everyone to assess the future impact of early stage climate technologies. And we really designed it to be a quick, easy way to use without deep climate expertise. And this is really important for us because our aim is to reduce the barriers of entry to impact assessment for users of all backgrounds. And this is where the Crane tool comes in. And here's just a quick look at how Crane came to be. So briefly, it all started in 2017 when Prime and Lyserta developed the first impact methodology to estimate forward-looking climate impact. That laid the foundation for Crane version 1, which was launched in 2020 with support from our early funders, which includes MacArthur Foundation, Lyserta, and Massey EC. And last year, we released Crane version 2, which was extensively updated based on user research, your feedback, and the latest methodology from Project Frame. And so looking ahead, what we're really focused on is expanding Crane's reach and capabilities and finding the right philanthropic and strategic partners to help us scale Crane's impact even further. And some exciting new updates. So we really invested this year to make the tool easier to use and for it to be more flexible. If you've been at our previous webinar, you have probably learned that we have a new feature, which is called a blank template for building models from scratch. Plus, we also launched several UI improvements, bug fixes, and you might have noticed that we updated our branding across both our tool, our website, which now also has a lot of new and useful information. And also lastly, on the community side, we've released a LinkedIn page, a newsletter, and our quarterly webinars. And just before we dive into our discussion, I just wanted to get a quick refresher on the actual methodology behind Crane. So Crane allows you to do both potential and planned GHG impact in a way that aligns with Project Frame's methodology. And to summarize, Crane takes the difference between incumbent and solution unit emissions to calculate unit impact, and it can do this for over 200 of its default models. Then it multiplies the unit impact either by the SOM, which is serviceable obtainable market, useful if you're focusing on a technology class or longer time frame, or if you are looking at a shorter time frame and if you have business data available, then you multiply unit impact by commercial volumes forecast to get planned GG impact. And of course, these two key approaches come with different considerations that impact investors need to consider when they're making decisions, which I'm sure we'll hear more about in just a few moments. And with that, I'm really excited to begin today's panel. So please join me in welcoming our panelists, Kavita Patel from MUUS Climate Partners, Chloe Coates from Zero Carbon Capital, and Saurabh Kumar from Clean Energy Ventures. And I'd like to start us with just a quick round of introductions. And I know before this panel, I asked you to prepare for like a very brief icebreaker. So I asked each of you to find one crane model that you find especially promising. So I'm really curious to hear your selections. And I guess, Kavita, why don't we start with your introduction and your crane model?
Thanks, Gigi. Hi, everyone. I'm Kavita. I'm a principal at MUUS Climate Partners. I'm on the investment team, but given the size of the firm, also co-lead on our impact measurement efforts. We invest at the convergence of advanced technology and decarbonization. So CO2 reduction is our North Star. We don't look at adaptation or toxicity or water reduction or anything like that. And as I was thinking about where Crane has really made my life easier, I thought of the grid-related technologies. So I'm going to go with the advanced distribution management system model because when you start looking at the impact of fault location or outage restoration on different grids, it can get really complicated. And so using Crane to have that consistency across technologies has been really helpful for us. I'll pass it to Chloe.
Great, thanks, Kavita. Yeah, hi everyone. I'm Chloe Coates. I'm the research and analysis lead at Zero Carbon Capital. We're a VC fund based in London, and our focus is on investing in deep tech for decarbonisation at the pre-seed and seed stage in Europe. So like Kavita, decarbonisation and emissions reduction is our north star. And the Crane tool is super useful for us in performing our kind of impact assessment before we do every investment. And it was interesting to look at the kind of list of case studies that are there because there are so many across all the sectors that we look at. And I think my favorite is probably there's one for electrochemical ammonia production to reduce the emissions from fossil ammonia that's used to make fertilizers. And I think that was probably the first model I used when I started doing impact assessments at Zero Carbon 2.5 years ago. So that's probably my favorite.
Sounds amazing. How about you, Saurabh?
Yeah, thanks. Briefly, I'm Saurabh Kumar. I'm impact manager at Clean Energy Ventures, so focused on managing the firm's carbon impact measurement methodology and investment sustainability practice. Similar to both MUUS and Zero Carbon, we have a super mitigation focused lens. Clean Energy Ventures invests primarily in North American and European climate tech companies focused on carbon mitigation. We do have an investment threshold looking for technologies that have the potential to reduce multiple gigatons of GHG impact or GHGs by over the next 30 years. So like Kavita and Chloe, measurement comes into our process quite early. Thinking about the frame templates, it's a good question. I think one that is really interesting for me is the distributed generation one. In terms of a promising technology pathway, I think that's certainly critical. I think we will need to see more distributed generation capacity, but it's also just a sort of interesting and elegant way to think through a pretty nebulous enabling effect. So I think just looking at the way that it digests the information and the different scenarios that it allows you to view, it kind of just helps with the process of thinking through that impact pathway in general.
Sounds great. Thanks so much for all your intros. And I'm just fascinated the selections that you took from the Crane tool, so diverse, and I just really love that. With that, I guess we can dive into our main discussion. So I know that each of you focus on early stage climate solutions, but investors specifically may approach impact assessment quite differently depending on their strategies, their theories of change, and other considerations. So I'm really curious about your approach and how each of you embed impact assessment into your processes. And also, just a quick follow-up, do you tend to focus more on the potential impact at the technology level or the planned impact, or perhaps both? Perhaps let's start with you, Chloe.
Sure, thanks, Judy. So we do impact assessment right from the very beginning. So even before something goes into due diligence, we kind of do a back of the envelope. Does this fit our thesis? Do we think it's in scope? And we do have an emissions target. So we want to invest in technologies that have the potential to reduce emissions by 0.5 gigaton per year at scale in 2050. So we're investing at the pre-seed and seed stage. So super early, these companies may not have a business model yet, which is why we focus on potential impact. So our focus is on doing top-down calculations. Is this a big enough problem that it's worth addressing? And do we think this technology can make a big dent in that? And then so we don't assume anything about the amount of the market that they will capture, but we assume that if it's the best technology, they will take a sizable chunk of it and have a big impact. So that means we're approaching problems, like fertilizer production, cooling, enteric emissions from dairy cows and things like that. But we do look at direct emissions reductions and also enabling technologies. So does this reduce emissions directly, or is it a critical enabler for a separate technology that might do the direct emissions reduction?
How about you, Saurabh? How do you approach your impact assessment, and how do you embed it into your investment process?
Sure. So I think much like Chloe, we begin right at the beginning of the investment process. It's sort of baked into the entirety of the diligence process for us. So we also have a mitigation threshold. I said earlier, we invest only in technologies that have the potential to show multi-gigaton impact through the next 30 years. So a little bit different than the way I know Zero Carbon and MUUS structured their thresholds, but because of this target, this bar, we have to do measurement quite early in the process. At that time, we use planned and potential impact through our modeling, but we use different measures at different times for different purposes. So when we're thinking about how we evaluate investments against our threshold, we think, okay, what is the actual purpose of that threshold? And for us, it's making sure that we're investing in the most promising technologies, but also we're holding ourselves accountable for making the most impactful investments, right? So we want to make sure that wherever we're sort of allocating our capital, it's doing the most that it can for an emission reduction perspective. So at the beginning and through the investment process, we're looking at potential impact, tweaking our modeling to look at what we can expect from a company through the long term. We do a market share adjusted potential impact. So the way in which we assess that through the investment process is primarily starting with top-down focus, looking right at the basic structure of the frame equation. Where are we starting? What's the total opportunity? And then how much of this opportunity is our company or technology likely, I shouldn't say likely, but where can we project them to capture that market? And we typically use modern comparisons or whatever legacy comparison there is to best underpin that terminal market share estimate, but essentially taking the overall opportunity, applying an S curve to it, and trying to understand what a what will happen on a technology level basis.
So it seems you use both, sort of like a combination between planned and potential impact, depending on the timescales that you're looking. Okay.
We use planned impact in our annual sort of portfolio management practice. So it isn't necessarily part of our investment process or investment decision-making practice, but in terms of having the capacity to support our portfolio companies when it comes to building climate impact capacity, we want to look at their near-term impact as well, considering especially that the potential impact is top-down measure. It's looking broadly at the market. We also want to factor in, okay, where is this company really starting? Where are they targeting their first impact, and how are they projecting that occurring? So CEV was founded in 2016. So at this point, some of our early companies are at that nexus of commercialization and have this planning or forecasting that they're doing. So we want to make sure that we are using that information as well when it comes to interacting with our companies.
Great. Sounds good. How about you, Kavita? What is your approach?
Yeah, so we use a 10-year time frame, and there's some similarities between the two. So I'll just note the differences for interest because everyone has their own approach. We use a 10-year time frame, one, to align with the life of the fund, and two, we just wanted to more heavily weight near-term impact versus longer-term impact. We do invest in both hardware and software companies, and so rather than having the impact threshold be on a single company, it's actually on a portfolio level basis. So we have a target of 150 million megatons emissions reduction potential at scale in 10 years. And so that gives us the room to more heavily weight companies that might be operating in smaller markets but having impact today versus maybe some bigger bets in new battery technologies or things like that that might take a longer time to scale but would have a much larger magnitude of impact if successful.
It seems like there are so many different approaches depending not just on investment focus, but even with the same methodology, there are tweaks and different approaches that an investor can use. But when we talk about the trade-offs between the near-term and long-term potential that you just mentioned, Kavita, I think there is a trade-off that investors have to navigate. So for those less familiar, so for example, some software-based solutions can deliver smaller but faster emissions reduction. But on the other hand, infrastructure solutions can take longer to scale but have a much larger potential. And of course, this also has other implications, such as on your timelines and returns on investment. I guess my next question would be, so how would you, Kavita, approach these trade-offs in your strategy? And has this, I guess you sort of mentioned, but has this influenced your investment decision? If you can share in more detail.
Yeah, it's definitely influenced our investment decision. And I guess I'll give an example. One of our companies is in the fuel efficiency space. It's a software solution, and it's kind of like Waze, if you guys are familiar with the driving tool. It reduces the amount of diesel fuel usage, saving cost for customers as well as emissions, and is actually a direct impact versus a lot of other software companies, which are enablers. But the market that it was operating in was a lot smaller than if you're, say, a new solar technology that could be deployed a lot more broadly. This was targeting a specific segment that has been a little bit harder to decarbonize than others, and we hadn't seen many competitors in this space. So it was a little bit more of a white space than solar, where there's a multitude of solutions coming up. And on top of that, even though this company was at a seed stage, they were already actively deploying and already had realized emissions that were extremely easy to measure because they were paid based off of fuel savings. So in that case, we felt that the immediacy of the impact and how easy it was to measure it, the fact that it was operating in a white space with few competitors, made it a really attractive opportunity for us from an impact perspective. And so it did have a place within our portfolio, but we still have that goal that the average portfolio company has to meet this 150 million metric tons target. And so that's how we ensure that we're not over allocating to those technologies, and we still are on a portfolio basis, making sure we're hitting high impact technologies.
How about you, Chloe? Do you have these challenges in your work and how to manage these trade-offs?
Yeah, I actually think it's such an interesting and important question. I think it's generally accepted, that the time value of carbon is important. If you can remove a ton of carbon or avoid a ton of carbon today, it's going to be more impactful than in 20 years' time. We have a limited budget to stay within 1.5 or 2 degrees. I think to stay within 1.5, we have 250 gigatons left. So that's about 5 years worth of the carbon budget. So if we can, remove and avoid emissions sooner, like that's going to have a big impact. For our fund, it's something that we're really thinking about at the moment. Because we're a pre-seed fund and our original target was to say, okay, in 2050 at scale, it needs to have this big impact. So we weren't really, in our initial methodology, weren't really accounting for the time value of carbon. But what we're seeing as our companies and as kind of climate tech as a field progresses is that you're getting many more of these enabling technologies that might accelerate adoption or bring forward, accelerate adoption and bring forward the time to market of some of these technologies. So how can you account for that? I think is an important question, and we're actually thinking about it at the moment. Or have done recently in the context of a kind of new battery technology, for example. We could say that transition is well underway. So how do you account for the additional impact of a new battery technology? And kind of the way we thought about it is, okay, if we can get this new, cheaper battery technology to market quicker, can we bring, that S-curve, forward? And then when you take into account the kind of area under the curve, that cumulative emissions reduction, what is the difference between what you assume your baseline is and what the new technology will enable? And it involves lots of conversations and trying to find data that can support your assumptions about what the shape of that curve and what the changes will be. But that's kind of a way we try to quantify the time value of carbon and to say, okay, given the carbon budget for 2050, I think to have a 50% chance of staying within 2 degrees by 2050, we have a carbon budget of 1,000 gigatons. So does it, is the difference between these two technologies, is the time saving of carbon in that sense, is that big enough to make a big dent in the carbon budget? So that's kind of how we've been thinking about it, but it's really evolving. So it's really cool to hear, how other people are trying it and what's worked for them in the past.
I do really agree with you, both of you, Kavita and Chloe. I think there's a lot of considerations you have to make, but before I go forward, why don't you, Saurabh, jump in if you have any further comments?
Yeah, I think both of these are very relevant in what we're thinking about too. And time value of carbon is something that we're very actively working on presently. But I think it's sort of one factor of a few that we think about, because I think ultimately you think about what is it that these models are for. And when it comes to investment decision making, right, you have your bottom line number, but there's certainly going to be a layer of interpretation on top of that. So I think we talk about the likelihood of impact and the context of impact. And we've come up with our climate impact taxonomy that sort of divides technology pathways by direct reductions, your hard to abate technologies. This is obviously, I think, where our portfolio leans because of our very broad scale view. Our portfolio does weight itself towards these hard to abate asset intense technologies. And then we have intelligent systems, which are, improvements upon existing technologies, and intelligent systems, which will likely be your software, hardware hybrids, or things with a primarily enabling effect, EV technologies. And Chloe brings up a great point, right? I think now in some of those enabling markets, we see more incremental innovations that have not necessarily that direct effect, but more of an acceleration effect. So sort of thinking through that in a very different way, but potentially on that side of the spectrum, it's a more quote unquote likely impact because the change is less of a bridge to cross. Whereas on the direct reduction side, there's a lot of assumption you need to make. So we quantitatively adjust by time value, and that's sort of influenced our ability and likelihood to invest in enabling technologies, or what we call advanced components, things like our recent investment in Ayrton, a hydrogen transport and storage company. And we view that sort of in the context of, okay, what's the impact? How likely is it? And then when is it occurring?
Can I ask a follow-up to that? So that's really interesting that you think of the likelihood. Is that like a number that you multiply your assessment by to say this has a 50% chance of success, or the more moonshot ones you say, okay, this impact could be massive, but the likelihood is 5% or something?
It's a good question. We don't quantitatively adjust by likelihood, but we do scenario analysis and interpret how tight the spread is, if that makes sense. So I'm personally, and in terms of managing our methodology, one thing that I always say is I don't like introducing erroneous layers when there isn't rationale, or when there isn't something observable or defensible to look at in terms of introducing that. So we have talked a lot in Frame about how do we integrate sort of attribution factors, how do we think about these different things that we can use to adjust net impact. And I think those things are being developed and will continue to get better. But the way that I think we're perceiving it, especially because we think about this on a pretty broad scale at CEV, is how do we do the analysis to analyze what the effect is and then present that analysis in the context of how it's happening. So doing an elegant sort of calculation to achieve a bottom line number, and maybe sort of the spread of what we can foresee that number being, and then thinking about, okay, but what are the assumptions that we're making to get there?
I think,
Gigi's
yeah,
about to say this, but on Crane, you can toggle up and down the uncertainty of the technologies, which has been a useful tool for us. And then we use kind of 5 to 10% market share usually as the top out. So it's not a true potential impact measure, but for us, usually if you look at the top companies in a given industry, they generally won't have more than 5 to 10%. And if it's more mature with a higher likelihood of impact, as Saurabh was saying, then we might be closer to the 10 than the 5. So those are two tools that we use with less precision, but gives you more of an order of magnitude measurement of what makes the most sense in that context.
this is such a great point. And also, when we do our work here at Prime, we also find it to be challenging sometimes because a lot of assumptions had to go into calculations. So sometimes you have a big unit impact, but the market is small, and sometimes it's vice versa. And both of these both of these components of the calculation are quite uncertain, and will really determine, alongside of the time frame that you're analyzing, how impactful your climate solution is going to be. And the more early stage climate solution is, the more uncertain the estimate. So that's always, at least from a technical perspective, is challenging to assess. Which I guess leads us to my next question about how all of these impact models are really not crystal balls, but they are based on these assumptions and data caps and evolving markets. But we really make it work because they're so incredibly helpful in making decisions, especially at a very, very early stage. So in regards of that, having confidence in the data, I just wonder, how do you strike the right balance between precision and practicality when modeling climate impact? Or in other words, what I want to say is, how do you decide when the model is good enough to move forward with the investment decision?
I'm happy to start. Yeah, I think I think the one thing I try and bear in mind is always just to remember the purpose of the impact assessment that we're making. Like the purpose is to make investments and try and steer capital towards the best climate solutions and the most impactful ones, and try and assess, you know, the risks, what are the things that could go wrong, and how big could the impact be if it goes right. And I think the purpose isn't to have a perfect, you know, academic literature level assessment where you think it's all going to turn out as you expect. So I think it's super iterative, and sometimes you don't know, you know, you could always do more calculations, you could always have a more accurate you know, number, whatever that means. But I think always to bear that in mind and just keep it as simple as possible. I think Saurabh said that last time, you know, have as few assumptions as possible, basically, so that you can state your assumptions, you can reference your data sources, and be as transparent as possible. And I think that's why things like Crane tool that has all these case studies, that Project Frame with all the case studies, I think these things are super important to help, you know, show people how investors are making decisions, and you know, make impact assessment more accessible to everyone. And also, you know, one final thought is just to always have in mind, you know, it might not be perfect, but like, can you stand by it? Can you defend, you know, the decision that was made if the impact, and if the impact doesn't quite work out, you know, maybe some of your assumptions are wrong, maybe, you know, there's massive tariffs that prevent something from happening, I don't know, you know, would you still be able to stand by that decision and say, okay, given what I knew at the time, I still think that was a good decision? And could I use this assessment as a precedent for future impact assessments? You know, do I think my methodology is robust? So yeah.
These
I'll
are
add
great
on to
points.
that. I think those
Yeah.
are some very good points, and a lot of that is stuff that immediately came to my mind in relation to this question. And I mentioned earlier, we do different types of modeling through the process. And so I think we're thinking about what is quote unquote good enough in different ways through that process. So at the beginning, our underpinning question is, okay, what do we need to believe for this to achieve our target? And can we believe that with a straight face, right? So in terms of defensibility, right, at that point, I want to be able to say that a technology will have an effect and be able to be confident about making that assertion. And then when we get further into that modeling and look for more sort of quote unquote precision, then I think, right, there is never necessarily a good enough. And that's the reason why we revisit these on an annual basis. And as Chloe says, things change. And part of this is just humility too. You need to be able to own and make clear where something just changed and you made an assumption that didn't pan out. Why didn't it pan out? And just be clear about that. So I think transparency is obviously a huge part of this. And ultimately, when it comes to the model that we're using to make our investment decision, again, right, that golden question is, what is it that we're doing this for? And I think different people in the asset stack will have, or sort of capital stack will have different answers to that. We see 3 funds here that do very similar things, but also do very different things. And I think that sort of plays out into how we're using that number to prioritize. So if you're a philanthropist, you're going to do it very differently than say an impact investor, and interpret it very differently than an impact investor. So I think all of those things just play into what we perceive as good enough. And ultimately it does come down to, if I'm asked to walk an investor through this, if I have to walk an LP through the logic that we use to get there, do I feel excited to do it? I don't want to feel scared to do that. I'd like to feel like I'm about to show them something they're going to find very interesting. So that's sort of that rule that I use too.
I love that rule.
Interesting.
For both our forward and realized modeling, we clearly lay out if an impact model is a high, medium, or low fit based on the data that we're able to get, and if it's a standard model that we feel fits the technology or doesn't, and also if the company is an enabler or direct impact. So to Chloe's point, being clear about the assumptions to make sure you can tweak it when things change is really important. And 2 examples of that we've looked at companies where they were in a specific market supported by the crane model, and post-investment, they entered into a new market that completely changed the market side to the upside. And the flip side of that is maybe you invested in a company that had a total hardware plus software stack. And 3 years into that, they decided to pursue a more capital light situation where they were licensing or maybe only selling the software part, and they've now become an enabler in one piece of that greater impact. So the changes can go both ways. And I think categorizing how good of a fit the model is and listing out clearly what the limitations of the model are and what was over or underestimated has been really helpful for us in LP communications. And like Saurabh said, feeling excited and not scared to walk through these models.
Mhm. Mhm. Those are such great approaches, and I definitely agree with all of you. I think it's more about the process or just like the exercise of doing an impact assessment as opposed to achieving the most precise end result. And especially when working with Crane and when talking to users who use Crane, we also stress that importance that modeling should be sort of a live process that gets you started on Crane and that you keep updating periodically as more data becomes available or as that technology evolves. So really agree with all of your sentiments that you just shared. I guess just to leave some time for a Q&A at the end, we can jump to our final remarks. So I just wanted to ask you all one question. If you have one piece of advice for a startup or another investor that's just starting their impact journey, what would that advice be?
I'll start. I'll just say, sort of keep in mind those central questions, that set of really kind of the golden rules that you should be asking yourself. Do you feel good about this? Ask yourself, what is it that you're modeling for and whether what you're building is achieving that goal. And know that we won't know the answer. We can't figure out how close we actually were when it comes to tons of CO2 equivalents. So, these things are only as good as we use them. So make sure you understand what it is that you're trying to get out of it and build for that purpose.
Yeah, I would
Such a
say
great piece of advice.
um, founders, even at the most basic sense, when pitching to climate tech VCs, should understand unit economics or at least the initial case study impacts. We're not expecting that case study to be accurate across the entire swath of the market you're trying to penetrate, but knowing that you have an understanding of the mechanics of how emissions are reduced through the process and how that might scale is very important. And use your impact story as a tool to help you in gathering resources. It drives performance in hiring, in fundraising, and with customers. And it is part of the core value proposition in a lot of cases for these technologies. So I would say, a lot of these companies are founded by engineers who are seeking a very high degree of precision and therefore sometimes shy away from doing these impact estimates. And I would say just lean into the estimates, know what the assumptions are, but understand what the story is when you take a step back and don't be scared to put something out there knowing that you don't have all the data yet.
Yeah, I would just totally echo what both of you said, that the story piece, initially is more important than the exact estimate. And by story, I mean, the theory of change, like how does your innovation lead to an effect that results in emissions reduction? And then an investor or someone else can work with you to backfill in what data you need for those assumptions. But that understanding of the mechanism of change and impact is the most important starting point. And sometimes you get really far down doing extensive calculations, and then you realize, oh God, that theory of change wasn't quite right, and then you have to start again. So really, the foundational mechanics of your impact and your technology are really important.
Sounds so great, and thank you so much for sharing all this. We'll open the floor for Q&A. So anyone who's here in this webinar today, if you would like to share your question in the chat or just unmute yourselves, now would be the time. And I also have a couple of more follow-up questions, but I'll let the audience jump in first.
So much for your time. I'm Sam McCafferty from HMC. We're working through trying to do some of this potential emissions reduction forecasting for our portfolio. And you mentioned, or a couple of the panelists mentioned LP reporting. I was wondering if you could say more on exactly what you're discussing with your LPs and if you're feeling any pressure to provide some portfolio or higher level aggregation, instead of just each individual company modeling, and how you deal with that, if so.
I would say that there's probably different things that are motivating us to have these conversations with LPs. We're an Article 9 fund, so our sustainable investment KPI is avoided emissions. We define it that way, and we hold ourselves accountable to making investments that meet that threshold. So a lot of times, I mean, it's certainly a factor that is marketed to our LPs, and it's a reason that they may allocate their capital with us, so they can be interested. That said, I think we have different types of LPs that are interested for different reasons. So when you think about an impact fund of funds, they're sort of collecting that information for their own purpose. But when you think about, say, like a retirement fund or an asset manager or something like that, they're collecting that information for a very different purpose. And I think it's important to understand or sort of keep in mind that impact measurement is an emerging and generally new practice, not only for GPs, but also for LPs. So I've found that, if you really get under the hood of that conversation, they also have a lot of open questions and are willing to have a conversation with you as to what metrics they want, why they want them, and you can sort of figure out where to go from there. We try not to alter or sort of like create KPIs particularly for individual LPs, but rather walk them through that approach and make sure that they have buy-in on that.
I would say the reporting that we've done is all at the portfolio level. And part of that is privacy with portfolio companies. In the same way that LPs don't always know exactly how many units of which business line at which margins were sold within the last year. You could say the same about the impact story, but what we do share is what the emissions trajectory is cumulatively for the portfolio and in which industries those emissions reductions are coming from. And then on each portfolio company, we'll share the logic model of these are the emissions it's reducing in this industry, and these are the total emissions of the industry and why we see high potential in the company. But we don't get into usually the nitty-gritty of the underlying individual company measurements. And the companies sometimes aren't involved in the measurement depending on the resources that they have. And so just being careful about what we are representing on their behalf as well is really important.
Yeah, I think it's a similar story for us, really. It's not that we wouldn't share the models. If the LPs want to see the models, we'll happily go through them with them. Same with the portfolio companies. We're happy to share all that information, but our LPs don't require it for reporting. Some of our LPs are Article 9 funds themselves. We're actually not an Article 9 fund, even though we basically operate like one. But some of our LPs are, so we have to, comply with their reporting and do the analysis of potential adverse impacts and stuff of our companies and report back all the ESG requirements that they have. But in terms of pre-investment impact assessment, we don't have to share all of it with our LPs, but we're happy to if they want to see it.
Thank you, Samantha. I hope that answered your question. A great question. I actually had that one as my follow-up questions.
I have a question. One thing that I see continue to pop up amongst project frame investors is this concept of like what data is good enough. And so I'm just curious, as Crane users, how often is there a rough estimate or a ratio of companies that come through your pipeline where you feel they are equipped with data that will serve your modeling purposes versus is it something that you really have to work with them to find out together and then try to input it into your Crane model? That'd be helpful for me to know.
Yeah, it varies. The data quality of the input data quality is sort of the biggest challenge with doing these, especially when the input data is itself a projection. If you're trying to estimate the market size of EVs in 2050, you have to rely on projections which have their own assumptions. So that depends. In terms of the quality of the companies themselves based on their technology, again, it depends. And for some of them, especially with direct emissions reduction, okay, sometimes the product isn't at scale, so you don't have the LCA data to say exactly what the unit impact of that technology is, but you can usually get quite a good estimate. And the challenge is often with the enabling technologies and how much of an emissions reduction can you attribute to that particular technology. So it varies a lot. It depends. Some of them will come from academic labs where they've done all that intensive calculations of what the emissions reduction is, and then some of them haven't got that data yet.
I had to give a range, I would say probably 20 to 30%. It can be quite difficult, especially if it's a newer technology or a market where less research has been done, but probably 70% of the time, either it's within an industry where there's been a lot of data that you are able to extrapolate from. Like, for example, maybe it's an electric vehicle applied to a new market, but there's a lot of baseline data to go from, or the company themselves have that data on hand and more specific industry reports that you'd be able to extrapolate from. But the 20 to 30%, yeah, maybe what the energy footprint is of the customer industry, and you have some sense that that they're reducing energy and increasing efficiency, but you don't know exactly how much, and it might still be a bit of a question mark. So that's where we run into challenges.
Thank you.
We have one more question, unless Saurabh, you'd like to jump in.
No, I guess the only thing I'll add to that is I think generally Chloe's right. If we have a company that is in a very direct sector, then they generally will have a techno-economic analysis that defines on a per unit basis what the impact is, right? Like if you're producing green steel, you probably have an idea of what the differential is, but they're sort of the solution statistics, the solution data, and the market data, and oftentimes we find the solution data is very sparse and the market data is there, but it might be of different qualities.
Thank you.
We have two more questions, maybe one answer each, since we're almost out of time, but I'll get a question from the chat first. So Daniela is asking, do you consider additionality in the due diligence or IC? If so, what's your approach? Whoever would like to tackle this question.
I would say we consider additionality when it comes to sort of that likelihood of impact piece. And there are certain sectors where we have a thesis on additionality or rebound and things like that. We don't underwrite impact for data center energy efficiency. For example, our sort of stance is energy efficiency created in data center context is not going to be an additional saving because there will be sort of more compute at equal or greater power. So I think there's areas where we have a discrete thought about it, but in areas where there might be a more sort of nebulous effect, it's coming out in that scenario analysis of what are the different assumptions, how does that spread occur, and how do we perceive that?
And Crane does take that into account to an extent where the unit emissions impact would go down over time. Which is helpful in doing the projections, because then you're not overestimating and saying that this technology is going to have additionality impact for a long period of time. It might be going down as there are new entrants in the market and things like that.
Yep. We do use some dynamic baselines. For some technologies, we assume a static one, but when using dynamic baseline, that would assume that the industry overall is, decarbonizing, and it would probably underestimate rather than overestimate the total impact. So yeah, good point. We have time for one more question. So Kara, if you'd like to unmute yourself, you can go ahead.
Yeah, thank you for the great talk. Nice to see you, Kavita. This is a question more about impact investing generally rather than reporting. I work at a venture capital firm that's thematically focused on the energy transition. We don't consider ourselves an impact fund, but we're thematically focused on, I would say, impactful technology. And what I have seen in my portfolio is a lot of technology that is, I would say, largely technically de-risked, on the brink of essentially being commercially ready, just needing to kind of scale up and execute that scale up and prove out those unit economics, and having a very hard time fundraising, the very large amount of capital required, because this is all also, I should note, like mostly physical hard tech, hardware product development, and it's very capital intensive. And I guess I just reflect on, and maybe I'm off base, but what feels to me like the trend is a lot of impact investing firms that I see, and I think some of the entities on this call would be in that category, in that they typically only invest very, very early stage, like the seed, pre-seed, bringing technology out of the lab. And I guess I was just curious to hear your perspectives on, maybe why that is the approach for your firm. Because again, from my perspective, it feels like a bit later is where impact dollars are needed that other financial institutions aren't willing to provide. And I've seen a lot of data and just my own anecdotal experience of there being still quite a big appetite for those seed, pre-seed deals within the typical financial community, in a way that maybe they call it a Series A or a Series B, whatever, is having trouble. So I'm just curious what your guys' perspectives are, or even just within your portfolio, if you are investors that maybe don't kind of participate later on, are you seeing companies similarly to me struggle in that kind of pre-commercial valley of death? And yeah, I'm just curious your perspective. Thank you.
Yeah, it's a great point. Just briefly, I think we see something really similar. Something, maybe 2 years ago, investors wouldn't expect commercial traction. It was fine to be pre-revenue and be speaking to customers, but the expectations of commercial traction are coming much earlier. So I don't know if that's what you mean by your experience, but that's something that we've observed in our portfolio companies as well.
Yeah, I would say that earlier stage, given ownership you're able to capture and exits that are giving you those venture-like returns, are why people are still gravitating towards the early stage. There is still a valley of death for hard tech companies, but those that in our portfolio or elsewhere that we've seen be quite successful have used the maturing capital stack within climate tech to get beyond that, as well as trying to take advantage of market dislocations that we're experiencing right now. So for example, we have one company that was able to get both venture debt and equipment financing, even as a pre-revenue hardware company, because of their cash management strategies, which was, you didn't really see as much of that 4 or 5 years ago. They were also able to get funding from the state for bringing in manufacturing jobs, which is replacing some, definitely not all, of the money that we might be losing from the IRA. And maybe the most interesting one is buying assets and also leasing a factory at a very low cost, because of some of the more mature companies that are experiencing financial distress due to the situation that we're currently in, and kind of flipping that and using it to their advantage. So Kara, to your point, I hear what you're saying. It's definitely a problem. We do need more capital in those spaces. I think even when the tech is de-risked, sometimes the pathway to commercialization, because customers have such a long adoption timeline, is what kills those deals. And I think one of the big remaining problems in the industry is how do we get these conventionally low tech and slow moving industries that climate companies are all trying to sell into to move faster? Like, what do we need to do to get their mindsets to shift to understand this is what I need to see in order to move forward and scale up from 1 to 100 faster instead of going 1 to 5 to 10, which they're doing right now?
Thank you all for your questions and your answers. Unless there's any final remarks, I'll just say that I'd like to share a round of applause for all of our panelists today. Thank you so much, Kavita, Chloe, and Saurabh, for taking the time to share your insights. Really appreciate it. And for all of those who are joining us as attendees, I hope you walking away with some useful insights. And I'll be sending a follow-up email soon with the webinar recording in case you missed any of the panel parts. And until then, take care, and I hope you enjoy the rest of your week. Thank you, everyone.
Thanks, Gigi. Thanks
Thanks,
all.
Gigi.
Thanks,
Bye.
Gigi.
Thanks all. This was great.